Okay, let's roll. Let's go. So the purpose of this video is to, in essence, show you how to evaluate a multifamily property for purchase and what should you pay for that property. So the first piece of information you want to get familiar with is a couple of key terms. So the cap rate definition. So first and foremost, you need to understand your cap rate for your area. And this is going to be dependent on your geography. So as an example, if you're living in Denver, if you have a specific cap rate, even an area of Denver likely has its own cap rate. So, and the same goes for Boston and LA and in Portland, Maine. So before you evaluate these multifamily properties, you have to understand your area's cap rate. And the cap rate by definition is the net operating income divided by, in the case of your area, you have to look at the sale price of something similar to what you're looking at evaluating for purchase. So if a property sold for $1 million, it had a net operating income of $100,000, then the cap rate is going to be what? 10%. So get about 4 or 5 properties in your area that are close to what you're looking to buy, and then reverse calculate your cap rate. Okay, so in my area, I happen to have a cap rate of close to 10%. So we're going to go through that, and I'm going to show you how that works so that you can understand that. So here's a property we acquired a little while back. I think it was, I don't know, I think it was 2016 perhaps. But as we go through here, the piece this is kind of the area that we want you to look at, okay? So first and foremost, we want to look at the gross rent of the property. And what I tend to do in gross rent is I typically look at about a 10% vacancy loss when I'm looking at that. In this case, again, this is a property I already own, so I was redoing the math, so it's not accurate here, but always take about 10% vacancy rate, because a lot of times you'll find that sellers have more incentive to inflate the income of a property and to deflate the expenses. So for you to be safe, to make sure that you're getting something at a good rate and taking the risk out of it, I always take about a 10% vacancy loss. And then I look at the expenses. And if we walk through these, you want to vet those expenses, okay? So cleaning and maintenance is a little bit of a gray area. It's probably one of the expenses that are most subjective. And for you, you want to get familiar with what it's going to cost you to maintain and clean a specific asset. But those are kind of the only subjective ones. Insurance, you can cover that. Taxes, electricity, water, sewer, oil, trash removal, elevator service in this case. I put an accounting expense in there. So the net operating income of a property is your gross income, okay, minus gross expenses. And that annual net operating income for this property is $203,000. So if we go back to that calculation, right, the value of a property is the net operating income divided by the cap rate. So in my situation, you're going to look at that and you're going to say, okay, so if my net operating income is $203,000, I divide that by 0.1, I would be willing to spend $2,003,000 or $2,030,000 for this property based on that math. So, in this case, I acquired that in 2016 for $145, I think was the end deal. And so obviously I've done some work since that point to change that, because at the time when I bought it for $145, the math worked out to about a 10 cap rate based on the expenses, because this gross rent was way less. And a lot of these expenses were higher. So this annual net operating income was about $140,000. And now it's $203,000. So it just goes to show that with 2 years of work, increasing rents, repairing stuff, reducing expenses, I've increased the value of this property from 1.4-ish to about 2 million in 2 years' time. So anyway, hope this helps you to evaluate your potential investment. And if you have any questions at all, send emails my way. It would be Philip with 1L, Henry at Canuck, CANUCK -investments.com. And best of luck with your investments. Take care.